Hi, my name is Avnish Jain. I head fixed income at Canara Robeco. I will discuss the outlook on fixed income markets globally as well as locally. First, let's take a view on the vaccination process, the pandemic. Vaccination process we started in December of 2020 and January of 21 has picked up pace in the recent times. Some of the large countries like US and UK have achieved large levels of vaccination, which have led to faster pace of economic opening and faster recovery. Countries like India still in the initial stages of vaccination. The second wave and the third wave have somewhat cautioned governments on faster opening of economies, and which has led to some lockdowns and localized lockdowns as well in the countries other than India. Recent spread of Delta strain also has led to localized closed lockdowns in various parts of the world. But that has not hampered the opening of economy, which are slowly opening up. Look, coming to global macro, growth has returned, but so has inflation. Inflation in the past few months across the world has shown a sharp uptick because of obvious reasons being supply disruptions. Commodity prices have seen a sharp increase because of, again, supply disruptions and renewed demand as economies open up faster. This has led to high inflation in many of the developed countries as well. US inflation touched 5% in the recent readings. However, central banks across the world have the view that this inflation is transitory and will come down in the next 1 year as supply pressures ease, and also the demand eases from the current sharp uptake in demand because of opening up. Coming to locally, we again face the same pressure. Inflation has been high in the last couple of readings. Growth took a beating in the first quarter of FY22 because of lockdown, but it should again spring back in the next few quarters as the economy has opened up after the passing of second wave. However, we should be mindful of the third wave, which is expected to hit anytime soon, and governments are cautious in opening up fully in many parts of the country. Recent upsurge in cases in Maharashtra and Kerala also point to a cautious approach of opening the economy. From the central bank side, RBI has been very watchful. While inflation has been high, they have been also supporting the global view that this inflation is transitory and will come down. In the recent credit policy, monetary policy meeting, RBI kept rates in abeyance. There was no rate increase or rate cut. Also, the accommodative stance continued, meaning RBI will be there to support the markets as and when it is required. Again, RBI believes that inflation is temporary and it should abate by the next year. As per their projections, inflation for current year, financial year FY21 would be around 5.7%, which they expect it will come down to 5.1% for FY2023. In terms of growth, growth is expected to be 9.5% for FY2022, which is compared to probably 1% last year because of the lockdown due to pandemic. So it will be a sharp turnaround for the economy. Coming to markets, markets have been fairly volatile. If you look at global markets or rate markets specifically, what we saw was that in April-May, because of high inflation numbers, markets did have some concerns and there was a sharp uprise in yields. But as central banks came to support the markets and again voiced their opinion on keeping rates low for a longer period of time, market yields have traced back and there has been sharp drop across the globe on long-term yields as well. Again, market believes that the inflation is transitory and probably will come down by the next year, same time. And central banks will continue to hold the accommodative stance, the ultra loose money monetary policy, so for some more time. There has been some chatter on the US Federal Reserve starting unwinding of the monetary policy. In the recent policy meeting, they have indicated that they started talking about it, but the US Fed chairman still is saying that any unwinding is far away. As per market expectations, there are expected to be no rate hike in the US till the end of calendar 2022. So RBI also is towing the same line. They also are continuing with the accommodative monetary stance of keeping liquidity very easy and also rates at the current level. Liquidity is ample in the system. We close to 10 lakh crores of liquidity is there, system liquidity. RBI is doing something to withdraw that liquidity, but those measures are very short measures which are being tried. Markets expect that RBI probably will start withdrawing those liquidity end of this year, FY22, but there are no rate hikes expected by FY23. So earliest people are saying that rate hikes may happen in early part of FY 2023. So we are still about a year away probably from the first rate move if it happens. Again, it depends on market conditions. RBI will be data driven. While growth has come back, depending on the waves of pandemic of COVID-19, whether the third wave comes and it again impacts economic growth, RBI may delay any normalization of monetary policy. Debt markets, again, local debt markets have been very volatile. We did see a rise in yields in the recent months. Probably driven by one, inflation has been high and it is a concern for the markets. We have seen last three readings of 6% plus inflation in the last three readings. That is above RBI's medium-term target of CPI inflation of 6%. But now inflation is expected to trend down on back of lower food prices. Monsoon has been good, so that also points out to much lower food prices going into the next few quarters. RBI again has been very watchful on the markets. They have been supporting markets through the buying programs, which is called the Government Security Acquisition Program, GSAP. In the first quarter of FY 2022, they bought 1 lakh crores of government bonds. Second quarter, they have committed to buy 1.2 lakh crores of government bonds. While pressure is there on the bonds due to excess government borrowing, which has been large because of pandemic reasons, government did do a lot of expenditure in the last year, and the same continues this year as well to ensure that the economic growth picks up. RBI has been supporting that borrowing through the various programs, open market purchases, and they'll continue to do so. Outlook for market is uncertain because it is data driven. Inflation, while it is expected to come down, there are a lot of uncertainties on the direction of other parts of inflation as economy opens up, and the pent-up demand could raise short-term inflation because of sudden pressure on prices. In that sense, RBI will continue to look through the recent numbers of high inflation and continue with their stance. But it is expected that when they see signs of durable growth picking up and economic activity being more anchored, they may start withdrawing liquidity slowly, probably through rise in raising rates on the reverse repo, not the repo rate, which is the key rate, and then go to the repo rate hike if required. So on the rate side, markets are likely to remain on the narrow range. We don't see any major rally happening. Also, any uptick will be supported by RBI. In the short term, I think markets may remain in a very narrow trading range, and RBI will continue to support markets. For our investors, my recommendation would be that continue with the current portfolio allocations. It is our job to manage duration of various funds. Investor need not switch funds on basis of duration. Currently, portfolio positioning is on medium to moderate duration across funds. On the credit side, we have been very careful and our portfolios are very high quality. They will continue to remain so. Investors should continue investing in fixed income. Any up move in rates would be very short-lived because, as we know, the markets are pretty volatile. Also, the economic indicators are also volatile. So we, as we have seen in the past few years, market cycles, especially on interest rate cycles, have become very short. So you can't really time those cycles. So investors should continue to invest according to their portfolio allocation and according to their risk appetites. So investors who are looking to invest for 1 or 2 years can consider the short duration fund or the corporate bond funds. And for longer term investors, the investment in dynamic income and gilt fund is suitable. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.